What are you expecting to hear from OPEC Plus? And actually, it's been pretty much stable, independently of what everyone has been saying. So what can OPEC Plus actually do?
Yeah, thanks for having me. You're right to point out that after the very tumultuous and exciting March and April months, the volatility in oil prices has reduced quite a lot. And prices have been much more stable recently. Having said that, though, even though prices look much more stable, there's still an awful lot going on in the background. If you look from a top-down macro perspective at the oil complex, it's sometimes useful to simply realize that oil is just another commodity, or at least to take that perspective, and to say, when do commodities do well? Well, they do well when the dollar is weak, when we start getting worried about inflation, when we have economic recovery, when we have growth in the money supply. Recently, we've had all of these factors that has provided a great tailwind to the broad commodity complex, and oil has also benefited from that. But if you then look at the bottom-up sort of barrel counting perspective of the oil market, you're seeing more signs of weakness. The demand recovery is still very fragile. Some of the curtailments in North America are slowly being unwound. Chinese imports are starting to soften. Refining margins are very low. And within that relatively complex set of top-down and bottom-up factors, OPEC needs to strike a balance. My expectation is that they simply will execute the plan that they communicated to the world back in April, and they simply execute that schedule, which is effectively set until well into 2022. So an incremental 2 million barrels a day in August was the plan, and I think that's the schedule that they're on.
But Martin, at the moment, I mean, it seems that actually OPEC Plus, so they're sticking to the agreements, and this is what they'll discuss, but they started also to unwind some of the output cutbacks, and you felt that, if I'm not mistaken, in physical oil prices. So do they need to stick with the agreement, but also stick with what they've actually agreed to and not cheat?
No, I think it's very important that they stick to the agreement. I mean, the OPEC Plus group is a very large number of countries. And to orchestrate production cuts of this size and relative to the agreed baseline, OPEC is running now minus 7.7 million barrels a day. I mean, this is a historically large OPEC cut. So to have this deep a cut agreed by so many countries, I think the only way to really be successful, or to kind of to keep the group together, is to simply execute on the plan. And the plan that was set out over the Easter weekend back in April is a very long-term plan. It has scheduled unwinds of these cuts, so every so many months until March of 2022. Opening this agreement and starting to change the agreed sort of schedule of unwinds would open up so many topics of negotiation again. The only way forward is to simply stick with the plan. In August, the quota is a 7.7 million barrel a day cut relative to July, when it was still a 9.7 million barrel a day cut. So, but all of that was already negotiated as per April, and I think simply for the coherence of the group, they'll need to stick to the original agreement.
Martin, Tom Keene in New York, good morning to you. I want to go to your physics background and your really, really thoughtful note on the future of big oil. It was on European oil, and we don't talk about individual names here. But Martin, I just want to go to the law of motion here. Are these big oil companies at rest, or are they actually in motion and will stay in motion towards some new paradigm?
Oh, they are in tremendous motion. The rate of change that is already taking place and will become more apparent over the next several months and several quarters is phenomenal in these companies. The coronavirus crisis has led to a structural rethinking of strategy on a sort of 5 to 10 year view in all of the European oil majors. There is a clear realization that betting on or assuming this sort of open-ended structural oil and gas demand growth year after year, as we've been accustomed to for decades, that may still happen, but it's much more of an open question. And there are scenarios where that simply doesn't happen. And if the traditional fossil fuel business enters a new paradigm, then also other businesses models need to build up. New energies, renewables, all these things. And there's a huge degree of change going on there. that we will hear more
But is it
in months to come.
Very quickly here, we're going to run out of time, Martin, but it's an important question. Are they going to be able to maintain cash flow for dividend payment with the new paradigm they're heading towards?
Yeah, frankly, this is the billion-dollar question, we put it mildly. So all these dividends have been reset lower, or at least the vast majority of them have been reset lower, and that really helps. The problem with the energy transition is that it's hugely capital intensive. Now, in the fullness of time, that will be offset by, hopefully decent returns. But for a period, it could be 5 to 10 years. We're looking at very high levels of capital expenditure that are required to fund the transition. Producing a unit of energy from, say, a wind or a solar project is about 5 times as capital intensive as producing a unit of energy from oil or gas. So as you switch from one business model to the other one, so you're looking at a period which is a multi-year period of a CapEx hump to overcome.